This video provides various examples of journalizing transactions. Before we start, let's review credit and debits. Which accounts do we record credits and debits? I find the best way is to utilize the mnemonic AED. A for assets, E for expense, and D for drawn. Any of those accounts, we want to record the increase on the debit side. Any other accounts, the increase will be on the credit side. Let's go to transaction D. November 18th, Net Solutions received cash $7,500 from customers for services provided. Right away, we know cash is the account to use. That's obvious. In cash increased, cash is an asset. We record the increase of asset on the debit side. The other account must then be a credit. But what account is that? Well, customers were provided services, so a revenue was earned. We called it the account fees earned. And we record fees earned on the credit side for the increase of revenue, $7,500. Total credits equals total credits. The accounting equation, cash, an asset, $7,500. On the other side of the equation, fees earned is owner's equity, a revenue account. Under owner's equity, it's increased $7,500. The accounting equation balances. On November 30th, Net Solutions incurred the following expenses: wages, rent, utilities, miscellaneous. All of these four expenses totals $3,650. Expenses is part of AED. In any of those AED, we record the increase on the debit side. So we list each of these expenses out. Wages expense, $2,125. Rent expense, $800. Utilities, $450. And miscellaneous expense, $275. All of these on the debit side. Then what's on the credit side? Well, that's cash. We know that's cash because cash was used for payment. It wasn't paid on account. Otherwise, we would record it as a liability, something like expenses payable, accounts payable, wages payable, rent payable, and so forth. Total credits equals total credits. Accounting equation balances. Cash and asset account is decreased. Expense accounts increased. However, expenses has a negative impact on owner's equity. So the increase of expenses decreases owner's equity. And in the accounting equation, we know cash and asset decrease. Owner's equity also decreased. The accounting equation balances. In all transactions, we need to ensure that all debits equals all credits. We do not have to check for accounting equation. It's only shown here for our understanding of making sure that these transactions are done correctly, that the transactions recording impacts the accounting equation, and if it makes the accounting equation still in balance, then it's likely to be correct. Transaction F. On November 30th, Net Solutions paid creditors on account $950. Right away, cash is the account to use. $950, a decrease of the cash asset account. So we record cash, a credit for the decrease of the cash asset account. The other account is not so obvious, but we know from the description that it's paying creditors on account, meaning that we had owed the money. We had an obligation, which was a liability that was recorded before. Now we paying off that liability balance, and it's on account, meaning we had purchased something on account before, and we owe $950. So that obligation, that liability before, is now reduced, and liability increase on the credit side. But now we want to reduce that liability, so we debit to offset the earlier credit. Because it was on account, we know it's accounts payable as the account that we need to use and record for the payoff of creditors on account. And again, accounts payable, a liability account. We are decreasing this liability, so we want to record the debit of accounts payable. Transaction G, Net Solutions purchased $13.50 of supplies on November 10th. Chris Clark determined that the cost of supplies on hand at November 30th was $550. So supplies was purchased earlier in the month and the balance of supplies was $13.50. But now, at the end of the month, November 30th, the owner goes into the supplies department or warehouse or a supplies room and determined that what's remaining on hand at the end of the period, the month ending November 30th, there was only 550 of supplies left. So what had happened to the supplies? It was used up. It was consumed. And when something is consumed to help the company operate and generate revenue, we call that expense. So for this transaction, we will use the account supplies expense. And this account increased because of the consumption of supplies. We need to recognize that we had incurred this expense for $800. Where does $800 come from? Well, if the beginning balance at the beginning of the period was $13.50 and now at the end of the period only $550 left, we can determine how much was used. $13.50 minus $550 equals $800. And $800 is our supplies expense to be recorded on November 30th. So then what's the other account? Well, the other account would be supplies because we incurred this expense and the supplies was reduced. The asset supplies was $13.50, now it's $550, so supplies had reduced and we recognize that by recording the supplies asset. Since it's reduced, we recorded on the credit side. AED, A for assets, assets decrease on the credit side. Supplies expense, AED, E for expense, expense increase on the debit side. So let's take a brief moment to think about what had happened. Initially, there was supplies and assets, and assets is on the balance sheet. There was a balance of $13.50, but during the month, some supplies was used up. So we recognized that expense, consumption, and we record it to expense, meaning that we transfer in the asset on the balance sheet to an expense on the income statement. And the income statement contains revenue and expenses to show the operating performance for the company for the period. So that's how this transaction impacts the two financial statements, the balance sheet and the income statement. The assets on the balance sheet is reduced, it's transferred to the income statement and recognize the expense so that it impacts the bottom line. It reduces the earnings of the company.